Welcome back. If you've ever watched your investments fall day after day and thought, this time is different, maybe the market will never recover, then today's conversation is for you. Every investor eventually faces a crash, yet almost everyone is convinced that recovery is impossible while they're living through one. Why does our brain betray us at the worst possible moment? To help us answer that, we're joined by a behavioral finance expert and financial psychologist who has spent decades studying market cycles, investor behavior, and the hidden forces that shape our financial decisions. So here's the question. Why does recovery feel impossible during a market crash, even though history shows markets eventually recover?
That's a fascinating question, because the answer has less to do with the market and much more to do with the human brain. Our brains weren't designed to invest. They were designed to survive. Thousands of years ago, ignoring danger could be fatal. Today, when the stock market crashes, that same survival system treats falling prices like a life-threatening event. Your heart races, your thoughts narrow, and suddenly, selling feels safer than staying invested. Here's what most people miss. A market crash doesn't just reduce your portfolio, it changes how you see the future. Psychologists call this recency bias. Whatever is happening today feels like it will continue forever. During a bear market, it becomes incredibly difficult to imagine green numbers ever returning. It's like standing in the middle of a storm and convincing yourself the sun no longer exists, simply because you can't see it. Then there's loss aversion. Research consistently shows that losing money hurts about twice what feels good. That's why a 30% decline feels emotionally devastating, even if your long-term investment plan hasn't changed. The pain is real, but it isn't always an accurate guide. Think back to 2008. Headlines predicted financial collapse. Many believed investing was finished. Yet years later, markets not only recovered but reached new highs. The same happened after the COVID-19 crash in 2020. While fear told investors to run, disciplined investors quietly stayed the course, or even not more. Recovery didn't announce itself with fireworks. It arrived gradually, almost unnoticed, while many people were still waiting for the right time to get back in. This is why market timing is so difficult. The best days in the market often happen shortly after the worst ones. If fear pushes you to the sidelines, you risk missing the very recovery you've been waiting for. Ironically, the moment that feels safest to sell is often the moment that offers the greatest long-term opportunity. Imagine planting a tree. You don't dig it up every week to check whether it's growing. You trust the process, because growth happens beneath the surface long before you see it. Investing works the same way. Recovery begins quietly, long before confidence returns. The investors who build lasting wealth aren't the ones who never feel fear. They're the ones who recognize that fear is a normal emotion, not a reliable investment strategy. They understand that markets move in cycles, but human psychology rarely changes, and that's exactly why history keeps repeating itself.
What a powerful perspective. The biggest takeaway is this. During a crash, your emotions are responding to short-term pain, but successful investing rewards long-term thinking. If this conversation helped you see market crashes differently, don't forget to like, subscribe, and share it with someone who needs reassurance during uncertain times. Until next time, keep learning, keep investing wisely, and remember, your greatest advantage in the market may not be timing, but mastering your own mind.